Does this scenario sound familiar? You've spent hours looking at charts, and when you finally found a trend that looks promising, you're not sure if this is a short-term spike or something worth following for a longer time. If so, that means you struggle to distinguish genuine continuation patterns from invalid ones due to market noise and false signals. Stick around and find out. What are continuation chart patterns with examples? How are these different from reversal patterns? How to determine the optimal entry and exit points. Please remember to hit the bell icon to subscribe to our channel for more crypto trading insights and tips. Now let's talk about continuation chart patterns. They appear during an ongoing trend, indicating that the current trend will likely continue. They typically consist of 2 or more candles showing a brief pause before the trend resumes. How are they different compared to reversal patterns? While continuation patterns reflect a momentary pause in the battle between bulls and bears before one side takes control again, reversal patterns, on the other hand, indicate that the current trend will change its direction, suggesting a shift in market sentiment. Take the head and shoulders pattern as an example. This pattern signals a reversal from an uptrend to a downtrend, marked by a peak, the head, flanked by 2 smaller peaks, the shoulders. Now, coming back to continuation patterns, there are 2 main types, bullish and bearish. Let's dive into each of them with some examples. First up, bullish continuation patterns. Bullish pennant. Imagine a small triangle forming after a strong price rally. This indicates that bulls are gearing up for another push. One efficient strategy that many crypto traders use is to enter long when the price breaks above the pennant. Ascending triangle. A series of higher lows and a flat resistance line. This shows increasing buying pressure. Look for a breakout above the resistance for a strong buy signal. Bullish flag. A sharp upward movement followed by a rectangular consolidation phase. The flagpole represents a strong rally, and the flag is a brief rest before the uptrend continues. Most traders choose to enter long when the price breaks above the flag. Now, on to bearish continuation patterns. Bearish flag. After a sharp decline, a rectangular consolidation phase forms. The initial drop indicates strong bearish sentiment. Typically, traders go short when the price breaks below the flag. Descending triangle. A flat support line with lower highs. This shows increasing selling pressure. One of the most common strategies is to enter short when the price breaks below the support. Bearish pennant. A small consolidation after a sharp drop. This signals that bears are ready for another leg down. Most traders prefer to take a short when the price breaks below the pennant. Now that you know the patterns, here's how to use them in your trading strategy. Step 1. Spot the trend. First, determine if the market is in an uptrend or downtrend using indicators like moving averages or trend lines. Step 2. Confirm the pattern. Validate the pattern with additional factors like volume or momentum. For example, in a bullish flag pattern, you should see lower volume during the consolidation phase and higher volume on the initial upward move. Step 3. Trade the pattern. Enter the trade when the price breaks out in the trend's direction. Set your stop loss and profit targets accordingly. For instance, let's assume Bitcoin is in a strong uptrend and forms a bullish flag pattern. The initial uptrend is followed by a consolidation phase where the price moves sideways or slightly downward. You should first determine the support level within the flag pattern. This is usually the lowest point during the consolidation phase. Set the stop loss slightly below the support level to account for market noise. The common approach is to place it 1 to 2% below the support. However, keep in mind that this is a typical and well-known strategy, and market makers will often try to exploit this strategy and use it against you. For instance, they can push the price through key levels, support resistance, to trigger stop orders, which can create a cascade of selling or buying pressure. Once the stop losses are triggered, the market maker can then buy back the asset at a lower price or sell it at a higher price, profiting from the induced volatility. And that's how you become a victim of stop hunts. But an easier workaround is Altrady's stop loss cooldown feature, which helps you specifically avoid stop hunts. For more details, check the link of our dedicated video below the description. Another useful recommendation is to test your strategies first with paper trading. This allows you to practice executing trades in real time using a simulated account without risking real money. It's an excellent way to gain practical experience, build confidence, and refine strategies before committing capital. To sum up, continuation patterns can provide invaluable insights into future price movements, helping you enter or exit trades at the perfect time. Remember to consider the overall market trend and use confirmation signals to validate patterns. And there you have it. Hope you found this information useful and feel free to share this video with other crypto traders. Thanks for watching.